Okay, greetings and salutations. This is our free office hour that we offer to people like Cynthia, like Ray, who have either purchased tutoring or a class. We put these on the schedule. It's again, sometimes it's capped at 5. We have more than 5, and we close it. Sometimes it's just the 3 of us. So whatever the case may be, and we basically, it's free form. Whatever you want to talk about, that's what we talk about. Cynthia has some questions from the Q Bank, so we'll be queuing those up and going over those. And if you want to join us for another office hour, if you have paid for tutoring or you've paid for a class, you're welcome to join us. All right, what's your first one, Cynthia? You're there?
Oops, I was on mute. I put it in the chat. I put 3 in the chat for now.
Okay, so 1 3 1 2 6 8 0 looks like that's our first one. Let me move the chat over to my other screen so I can see it.
And I have a few others, but I don't want to take up the whole time. So I'll just do 3 for now.
We have an hour, so Ray will go with Ray. Ray, do you have anything, or are you just along for the ride? What test are you taking?
A little bit of both, but I'm taking the series 7.
Okay. Do you have anything you want to do today, so we can just time our hour so you get done what you want to get done and Cynthia gets done what she wants to get done?
Not really. I'll just let Cynthia go.
Cynthia it is then. Cynthia it is. Cynthia is the winner. All right, let me blow that up so we can see it a little better. Which of the following best describes the effect of reinvesting mutual fund distributions? Well, remember, the idea here is that over the long term, the securities prices are going to be going up, right? And so you're going to be paying more for the shares this year than you did 15 years ago, right? Because you're buying new shares based on that higher NAV. So I would have said A, but let's see if we could have done this by process of elimination. Capital gains are reinvested to have tax deferred status. That's not true. You get constructive receipt of the capital gains, and you're going to have to pay taxes on that. Dividends are not tax deferred. A dividend that passes through to you is taxable. And the reinvestment of capital gains and dividends certainly do. Now, as a test taker, I call this the principal mutual exclusion. And you know that it has to be A or D because they say opposite things. And, I always say Socrates is a dog. Socrates is a philosopher. He's either a dog or philosopher. He's not both. Now, the way this shows up on the exam is what we call a DRIP, a dividend reinvestment program. You're not going to be tested on it has a higher cost base. What you're going to be tested on, Cynthia, is to know that whether or not you participate in the dividend reinvestment program, you tell either the company, or in this case, the mutual fund, you don't need the money, just buy additional fund shares. The IRS says you could have got the money, and that's the same as getting it. And so the test question isn't so much this Kaplan practice question. It's that knowing these capital gains and dividends are taxable to you. Does that take care of that question for you?
Yes, thank you, Dean.
Okay, let's see. Let me put in the next one. The next one is 147 6237. The sale of securities in a restricted margin account affects all of the following. I think this is a tough one. And you're not going to get a lot of margin questions. But to do this, what I suggest maybe is you make up an easy margin account. Right? If you're going to make up your own question to illustrate something, I suggest you make up an easy one. And you should know the classical margin equation. The classical margin equation is long market value minus dividend. Now, you should know the restricted means less than 50% equity. And so I'm just creating a scenario to illustrate this question where indeed we have a restricted account. Restricted means it's below 50%. And what the restriction is you can only have half the proceeds. So now I'm just going to sell securities. I'm going to make a mark to market. So the key to these is to be able to do a setup and a mark to market. And so that is our classical margin equation. Boom. And what you should know is the classical margin equation, which is that. And now I'm going to say, I'm just going to make up a number and sell securities and see what happens. So now we're going to do a mark, and let's say we sell $5,000 worth of securities. I just made that up. So if we sell $5,000 worth of securities, this goes to 35,000. That's our new long market value, right? It was 40 and we just sold $5,000 worth of securities. Now, if I'm a margin clerk, any money coming in your account is going to be used to pay down the loan. So I'm taking that $5,000 and I'm paying down your loan, right? You now owe the brokerage firm $25,000. And we have now illustrated that indeed, when you pay down the loan, the equity has remained unchanged. You still have $15,000 in equity. And boom. Now, by the way, the market value did change. I just made up the numbers to illustrate it. So sometimes, even if it's not a math question, you might want to turn it into a math question just to illustrate, right? So market value changed, the debit balance changed. By the way, that's important. If you have a margin account at your brokerage firm and any money comes into the account, it'll be used to pay down the loan. And then there's no SMA. Now, you could have had, if you didn't take the entire 5,000 here, I say, Cynthia, you said, well, Dean, what if I want money? I said, well, you can only have half of it. So if you wanted half of that, I would send you $2,500, right? But then, I wouldn't have as much money to pay down the loan. So if you don't take the entire 5, Cynthia, what I'll do is credit your account for the half you could have had and chose not to. So I could have ended up making a special memorandum of the account. Does that help on this one? Not a big deal. Not a big deal on the test margin. 3-4 questions.
Okay. Yeah, this one, like, I couldn't figure out how to just set it up the question, but now it makes sense to kind of
Yeah,
do it
and
the
remember, you're
math
going to
to
make
it.
up your own question, make up an illustration. Just make sure you make up an easy one, right? You don't want to make up a margin account that has $39,985 or something, right?
Yes.
Okay, so let's see. Our next one is, I would definitely know the classical margin equation, but definitely make sure you know that. Okay, and let's see. We're going to go our next one. Come on. That was 147. So 126. 126. 4330. Which of the following regarding a bond trading flat? Trading flat, by definition, means no calculation of accrued interest. And then the key here is it says not true. So this term, it's like learning a foreign language, right? They say when you dream in it, that's when you know the foreign language. So when you hear that word, trading flat, that means no calculation of accrued interest. The buyer does not pay the seller of an income bond accrued interest because, again, it only pays interest when and if earned. It may have interest in arrears. Yeah, that's true. Remember, this is asking not true. Bonds in default have no calculation of accrued interest. So income bonds and bonds in default, we have no calculation of accrued interest. The buyer just pays the price of the bond and they're done. Remember, normal other bonds, the buyer owes the seller the number of days of accrued interest from the last interest payment date up to, but not including settlement. Do zero coupons have a calculation of accrued interest? They do not. So income bonds, I think the more likely way this would get tested, Cynthia, is with an A, B, where you have the income bond, you have a bond in default. Kind of makes sense, by the way, because the buyer says, well, you didn't get paid. What makes you think I'm getting paid? And then I would think it would be the except format. All the following bonds trade flat except. So I think that's how that would be asked on the test. Any question on that one? Arrears just means, they owe interest. That's what the word arrears means. Let's see what Kaplan's explanation is. Yep, yeah, it's pretty straightforward. All right, so let's see. Our next one, that was 330. So our next one is 126 4876. A speculative investor believes the Japanese yen will remain stable. So that means he thinks it's stuck within a trading range. Which of the following positions might allow the investor to take advantage of a lack of movement in the exchange rate between the yen and the dollar? This has nothing to do with foreign currencies. This is testing you on what option strategy do you use when you think something's not going to move and is going to be in a trading range. You would use a short straddle. Let's just go through these. Long straddle, you expect the Japanese yen to go way up or way down. A call debit spread, you think the Japanese yen is going up because debits call spreads are bullish. And a put debit spread, you think the yen is going down. So that was a tough one. That was a tough one. Short straddle. I think that the difficulty here is I think that the camouflage of it being a foreign currency question when it's really not. What I mean by it's a camouflage question, the key thing is nothing to do with currencies. It's this. That's the hint, right? And this is the hint that that's a short straddle. Okay. Any question on that one?
No, that was good. Is that another good one to maybe do an illustration with it to just?
Well,
Can
we
we
don't
get
have
the
the
visual?
premiums. We don't have the premiums, but
Oh,
you know,
that's a good
here's
point.
the, yeah, we need the premiums, right? There's 4 test questions about a straddle. Can you identify it? Can you calculate the break evens? Can you determine where it's profitable, when to use it? 2 things, you can go to the search bar on the channel and put in straddle, and all my stuff will come up, including questions like this. But what I'll do is I'll link in the video description to an example of a straddle for you. I'll link to both the lecture on the straddle and a particular question that I think illustrates this concept.
Great, thank you.
Okay, let's see. Our next one is 1375 231. An investor submits an immediate or cancel. So remember what immediate cancel means. You know, I'm into instant gratification. Give me what I can get, cancel the balance. You know, I use the analogy, if I have the boys basketball team in the van, I go into McDonald's, I say 10 max, 10 fries, 10 shakes. They go, Dean, here's 4 max, 3 fries, and a shake. I'll accept partial execution. So that's important. When the order reaches the trading floor, the quote is 32.18, 32.16, 26. So 6 by 8. That's called the size of the quote. So somebody right now is bidding or willing to buy 600 shares at 32.18. So I'm just going to take the liberty putting the bid there. And let's make that so it fits. And boom. And this is the ask. And this is an auction. And this is called the size of the quote. And so somebody is willing to sell or is asking 32.26 for 800 shares. So my customer wants to sell 800 shares at 32.15. So I'm going to have to match them with a buyer, right? So this is a New York Stock Exchange stock because it says trading floor. That's the hint that I know that. And this is a buy limit here, where the New York Stock Exchange can best be characterized as an auction order driven market. And this customer is a seller. And so I have to match the seller with a buyer, right? That's what we mean. We're going to match that. So my report to the customer is, hey, I got some good news for you. You wanted to sell it for 32.15 or better. And good news for you, you got price improvement on the New York Stock Exchange. You actually got 3 more cents, 32.18. New York prides themselves, Cynthia, that you might be pleasantly surprised when trading in this auction. Listen, by the way, you're never going to be pleasantly surprised in an over-the-counter transaction. All the surprises are going to be unpleasant, right? Please note, we did follow the convention as well. The sell limit, this was a customer's sell limit, and we did place this below the current market price, right? That was placed below this. This one's a tough one too. I think this one's pretty tough. All right, let's see what Kaplan's explanation is. Do you know what you wanted to answer here, Cynthia? By the way, I'm in trouble if I buy it from you at 32.15, because then I would be taking advantage of you, right? If I buy it from you at 32.15 and then sell it, that would be the broker dealer stealing 3 cents from you. You don't, as a seller, remember, you don't get the high price. You, as a seller, you get the low price. And let's see what Kaplan says here. Oh my goodness, whole paragraph. Immediate cancel is limit order requiring immediate execution or cancellation. Oh, I forgot about that part, right? There's not 800 shares there. There's only 6, right? So that's why it's 6, but we didn't have a choice to deal with the 8. So we wouldn't have missed that anyways, right? Anyways, immediate cancel, fill or kill. Remember, I want it all and I want it now. If I can't get any part of it, I'm out. So, like immediate cancel, like immediate fill or kill, you want it now. But unlike immediate cancel, you will not in a fill or kill accept partial execution. Okay, any question on that one? Tough one. That was a tough one. Let's see. So our next one is, that was 1, 2, 3, 1. Our next one is 1, 3, 3, 6, 8, 1, 7. Oh, I like this one. I like this one. Remember what is our memory aid device for orders placed below the market? What is our memory aid device for orders placed below the market?
Slobs over bliss.
Yeah. And we only adjust orders that are below the market. Because, the order can't be triggered by a dividend if it's above the market. Because remember, the stock is going down by amount. It should open up at whatever that number is below that, right? So we're looking for an order below the market. So buy 100 XYZ 60, do not reduce. That's ridiculous because that is a buy limit, but it says do not reduce, right? DNR does not mean do not resuscitate. This client is saying, Dean, I know that you normally do reduce the stock. So let's say the stock right now is 61. I'm just making that up. And let's say it's $1 dividend. So we would expect that stock to open up at 60, right? And this guy's saying, Dean, don't adjust my order. Okay, the sell limit is above the market, so we don't adjust that. There's no way for the sell limit to get triggered as a result of the dividend. So we leave that one alone. A sell stop, yep, that's below the market. So a sell stop we're going to adjust, and a buy stop is above the market. We only adjust orders that are below the market. So boom. By the way, if I missed this, I probably would have missed it with 1 and 3. And if you missed it with 1 and 3, that just means you didn't know that DNR means do not reduce. And now you do. And now you do. All right, let's see what Kaplan's rationale is. Orders placed below the market are automatically reduced on the X date. The exception of the order is marked DNR. Well, there we go. All right, this looks like our last one. 1, 2, 6, 5, 0, 0, 4.
Hey, Dean, real quick. Are they going to have the types of questions where it says like 1 and 3, 2 and 3?
No, you don't get any of those on the
okay.
actual exam. None. Your NASA exam, they still do that, but not on the FINRA exams. Okay, so you calculated. It says I calculated. I got 150. All right, well, let's see what you did. You bought a 50 call at 4. So lots of ways to do options. Probably, ladies, if you've been watching my channel, I always say fire up the T, fire up the T. And so I bought the 50 call at 4. Is that money out or money in?
Money out.
Right on. I like to do it on a per share basis. And so that's 4 out. That was an opening purchase. That was an opening purchase. And I bought a 50 put for 2.5. So this is a straddle. This is a straddle, right? I'm buying a call and a put. And when I'm buying a call and a put with the same strike price, this is called a straddle. A straddle. And then it says both options expire on exercise. That means they expired worthless. So now I just put that in there. All right, that's what it looks like if they expire. And so I lost $400 on the call. I lost $250 on the put. And so the answer is A. By the way, that means the stock was 50. Because at 50 is when these expire worthless. Right? So you got, I'm not sure how you got 150. I think you put them on the wrong side of the T then.
Yeah, right. Yep. Right when you did that, I realized, yep.
Yeah. Well, listen, Kaplan or jerks, if there's any way to screw it up, Kaplan's got one of those choices available for you. right? So you feel good until you score it and you go, oh, all right. So that was a straddle. By the way, you asked me about a straddle earlier. And so here's an example, Cynthia, where I could have asked you the break evens. The break evens would be total the premiums, 6.5. Our upside break even is 56.5. Our downside break even is going to be 50 minus 6.5. I'm using my calculator because my arithmetic is really bad. 43.5. Right. And then it's long straddle. So we test question number 3. We want it to be either above 56.5 or below 43.5. That's why we're a loser. And when do we use this? We expected volatility. You asked me to give you a visual representation of this. So here you go. And so what we're straddling is the strike price here, which is 50. And so that's why it's called a straddle. And we have an upside break even. You know, we're buying volatility. Right. So there's our break evens. 56.5. 43.5. And then silo, short inside, long outside. So where I need this thing to be a winner is above 56.5 or below 43.5. What I don't want is the stock in between there. And that's why we're losers in this position. By the way, you can only lose what you invested. That sounds like a bad thing, but that's a good thing. All right, looks like we've got some more here. 1, 3, 5, 2, 1, 1, 1. Oh my goodness. You have a client who plans to liquidate some CDL stock to help pay for an upcoming family vacation late August. When checking the account record, you find the following transactions. We bought 100 shares at 43. We bought 100 shares at 39. We bought 200 shares at 48. The client needs about $4,000 and is currently selling for $44 a share. From a tax standpoint, well, what we want to do is sell the ones we have the highest cost base on, because that would have the lower tax, right? So what we want to sell, he says he needs about 4,000. So we would want to sell the ones that we bought at 48, because that would generate the lowest tax, right? So let's see what our choices are. Yeah, right. Now, remember, you can do this any way you want, but that would generate the lowest tax bracket. What if you didn't have good records? Well, then the IRS would impose upon you FIFO, and they would assume you're selling the shares at 43. So when you're buying shares over several time frames like you are here, you can do share identification. That's what we're using here. You can do average, and you can, if you can't do either of those, the IRS is going to impose FIFO. And there we go. Yes, I think it's more testable to know about the FIFO than actually doing this, right? What did you want to do on this, Cynthia? Did you want to do something else? Well,
Yeah, no, that one was really, I think I got caught up on exactly
okay.
that.
Right,
I think I had
one is 1, 4, 5, 2, 4, 5, 7.
Dean.
Erica. All right, so here you go, another short straddle. So first thing we got to do is when we're selling the straddle, right, we're going to receive the premium. And whenever we're looking at a bid and an ask, remember the customer always receives the low price and pays the highest price. What's that called? The securities industry, right? That's how we make our living, the difference between what we buy and we sell things at. So that's going to be our bid. And this is our ask. And boom. And here, this is our bid. And this is our ask. So now I'm going to make my tea. I'm going to make my tea. Fire up the tea. So when a customer is looking at a bid and an ask, the customer receives the bid and pays the ask. In a straddle, we are selling the straddle. And so we're going to receive 3 points for the 30 call. Boom. And we're going to receive 225 for the put. And so that's $525. Now, remember, Cynthia, what do you have to do in a straddle? You have to identify it. So if you don't know this is a straddle, you don't know that you're selling both these contracts. So you got to identify the straddle, even if that wasn't a test question. I just told you it is, right? But then you have to calculate the break evens. The total premiums is 5 1/4. So our upside break even is 35 1/4. Our downside break even is 30 minus 5 1/4. Our downside break even is 24.75. Where is it profitable? Silo, short inside, long outside. So we need it to be between 35 1/4 and 24 3/4. And then when do you use a short straddle? Remember, this is now the third time we've seen our second time a short straddle. When you expect a volatility, right? Excuse me, you're selling the volatility. You think it's going to stay within the trading range. Okay, it looks like our next one is one. 131 2724. You had the wrong month. Well, I don't know. An investor writing a 50 put. So I have an obligation to buy the stock at any time between now and October. I have an obligation to buy the stock at 50 anytime between now and October. So I need to offset that with a choice to buy. Right? So I need a choice to buy the stock to protect this thing. And so an investor writing the 50 put could cover if I buy the 55 put, that would be cool, right? Because if somebody sticks it to me at 50, I could stick it to the next guy at 45. 45 put wouldn't be covered because I would have a credit spread and I'd owe some money. So you should know it should end, it can't be 45 because you lose money. And you need July wouldn't work because then you're exposed between, July when that expires in October. And a 60 put, again, the problem with that is the time. So that's a tough one. That's a tough one. But that's a calendar, that would be a calendar debit put spread would be covered. All right, so let's see. It looks like Erica has joined us. An individual purchased his residence 5 years ago for $300. For 3 of the last years, the client rented out the property for income and lived in the house for 2 of those years. The client, I have no idea. I'm not a real estate person. Do you have the answer key and rationale? Erica?
Of course not, Dean.
What I tell you, you need the answer key and the rationale. My guess is 200,000, but what do I know about real estate? I would think that's a $200,000 capital gain, but I have no clue. I think the rent we handle separately. That would be on my tax return in a different area.
Dean, I got a question ID for you. These are really tripping me up.
Okay, well, hold on. Let me get out the Kaplan Quebec. I got to get out of this one and go to 66. Okay, boom. Okay, I got to find you guys again. Okay, can you guys see the QBank?
Yeah.
Okay, what's the QID,
Yes.
Erica?
152
Yep,
1420.
1420. Again, I will link to this. There's all kinds of, you put tips in the search bar on my channel, 4 or 5 versions of this question will come up where you can watch me do a video explication of it. But the way I told you I would go about this is I would say, okay, the interest rate's 4. That has nothing to do with answering this question, 0. The inflation rate is 5. That has something to do with this. We're going to credit the government. The US government says, Erica, in a tip, we're going to adjust your principal by whatever the CPA or CPI rate is. And so if it's 5%, we're going to adjust this 2.5%. That's half, right? We're doing it every 6 months. So what you would do is you would take the $1,000 I wouldn't do this, by the way. What I would do, to be honest with you, what I would do is just take the 50 and say, well, 5% is $50, right?
Dean,
That's-
are you recording this?
I think I am. Yeah.
Yeah, you are.
Yeah.
Okay.
So I would say, okay, if I'm getting $50 for 4 years, I know it's going to be something north of $1,200. So I'm a hack. This is a shortcut. So I say, Erica, I know it's $50 at least each year. I've had it 4 years. So I know it's got to be something more than 1,200 because it compounds. So I would have just taken this 55% and said, okay, that's going to be $50 times 4 years. That's $200. And so that's something north of 1,200 because it compounds. Now, if you don't want to do that,
No, I want to do that. This is your current yield trick, so I'm all about it.
well, there you go. So the other way, if you're not going to do that, then you got to times this by 102%.
No, spare me, Dean.
Well, I'm just showing you, show what it looks like. So after that first 6-month time frame times 102, so that's going to be 1,025. And then I'm going to take the 1,025 and I'm going to times it again, the next period, right? The next period is 1,000. So now I'm going to take 1,025. I'm going to times that by 102.5%. And so at the end of the first year, that's 1,025 times 102.5%. And now it's 1,050. And I'll say it this way, Erica, so on and so forth.
There we go.
Which means, anyways, if we did that 4 times, well, no,
Mhm.
8 times because it's 4 years. If we did that, we would end up with this number. But as I say, let's see if Kaplan shares the trick with you. Let's see if they share this trick with you. Yeah, there we go. So see the trick at the bottom. So a TIPS bond's principal increases every 6 months based on
Oh, nice.
inflation. That's testable. An annual inflation rate of 5% means the adjustment each 6 months will be 2.5. At the test center, enter the 1,000 multiplied by 102 and 5. I did that. Take the result, do it 8 times. If you remember our shortcut, you simply take the annual inflation rate and you times it. That's what I did, 1,200, and you take that next highest answer.
Perfect. I got another one for you, Dean.
Okay, hold on. Let me get back to the QBank. Okay, what's your next one?
152.
Yep.
1362.
An investor is reviewing his portfolio to compute the real rate of return. So when they say real rate of return, what they're asking you is how much, Erica, is the government confiscating from you, right? You don't get to keep all your money. I mean, taxes are the price you pay for civilization. So the key on this question is the real rate of return, right? That's the key, except these are all the following. We don't need to know the real rate. Now they're asking you to adjust it by this, my bad. So it's the inflation rate, the gain or loss, and the income, and you just to subtract that. So they got me on that one. So
Got
effectively,
me too.
investors were rated to compute a total return by the cost, subtracting the inflation rate. Yeah, this is sometimes referred to as on the test constant dollars. Constant dollars. So yeah, you got to be real careful on those excepts so you don't downshift on them. Do you remember what you answered on this one, Erica?
The wrong one. I didn't know what
Okay.
I was looking for, Dean.
Okay, well, that happens. Okay, any
I
more?
spun around twice and I clicked
Yeah,
maybe I assigned it to the universe. I don't know.
I like it. I like it. All right, anything else, ladies?
Yep. I got more for you, Deanie.
Okay, what do you got?
I got 152 1397.
If you knew a given stock had a 40% chance of returning 10%, a 40% chance of returning 20%, a 20% of turning, Eric, again, on these, I think you should just guess being a sign of the universe. I mean, I think this is a lot of work, and I've never had anybody on debrief. Now, you went into the cave to slay the dragon one time already. I
Right.
don't know if this was the difference or not, but anyways, as our friend Chuck tells you, the math is as follows. You take the 40% chance, that's what 0.4 is, times 10, plus the 40% chance at 20, losing 20. And then you take the 20% chance of earning -10. And then when you add that all together, you get a -6. And then, Chuck is the guy who does this, is negative return. I don't think that's going to be the question, Erica. I think on the test, what they're going to ask you is standard deviation.
Mhm.
You know, how much is usually what they do is they show you two investments with these returns. And they'll say which one has the greater volatility. And they would both have -6, but then you would have to pick out the one that has -6 with the volatility. All right, what's your next one?
Okay,
Is that it?
fired up. No, never know. No, no, no. Just got you back from the grid. Just a second.
1 4. Oh, is that a series 7 one? Oh, is that an example you're talking about, Cynthia?
Oh yeah, I just put two in. One was a series 7 markup question.
Okay.
5% markup question.
We'll go back here. We'll let Erica have one more. Oh, Ray has one. Oh, we already did Ray's. Okay. Okay.
And-
So Cynthia's
and
next.
then,
One more, Erica, and then we
yeah,
do. What do you got, Erica?
Okay, last one is 152
152.
0875. You'll see a trend here with the questions I'm sending you.
Yeah, the bond's present value. So this is by definition. So, I know that you are a flashcard kind of person, I think. And on one like this, I would suggest turning this into a poor man's flashcard. And what I mean by that is you don't want to even be looking at wrong answers here.
Right.
You just want to know what that definition is, right? Which of the
Mhm.
following statements best represents a bond's present value? But remember, what we're doing here is discounted cash flow. That is actually the definition. I love Kaplan and Chuck. This is the textbook statement. So here, boom. There are two future cash flows from a bond: the semi-annual payments and the principal at maturity. So let's see what our other choices were and see if we feel good about any of these other choices as a good misses. The present value is the sum of all the discounted future interest payments. Well, the reason that's not correct is because remember, if you buy the bond at a discount, you're going to make some money by holding it to maturity. And that's got to be factored into that. So that's why B is not correct. C, the present value is the discounted future repayment. No, remember, it's also the interest payments you're receiving. Present value represents the internal rate of return of the bond. No, internal rate return is what brings the future value to the present value, but it's not the present value. I think D would have been your best miss here. That's what I would have thought would have been the most reasonable miss. All right, back to the 7Q bank. Boom.
Do you have any videos for time weighted, dollar weighted IRR?
I do it I think I do it in the explication. So if you go to the 66 in the test specifications, you would find it there. But remember, you can go to the channel search bar, and put in time weighted. Anything I have will come up. So, I think people should be using that. It's an easier way to find things amongst those videos. All right, let's see. Series 7. Here we go. Boom, boom, boom. 1 4 0 2 8 3 7. A registered rep receives a customer order to sell 100 shares of ABC and use the proceeds to buy 200 shares of M&O. So when you customer, this is called a proceeds transaction. A proceeds transaction was the customer that says sell security A to buy security B. Now, for purposes of the 5% policy, not a rule, a policy. Remember, there's a difference. A policy is for the guidance of wise men and women. A rule is for the blind obedience of fools. So I can charge somebody more than 5%, but the broker dealer has to have normal patterns to its charges. If it departs, it has to have a reason. And there are good reasons and bad reasons. Here's a bad reason. You're the last trade of the broker month, and I got to make it up on someone. No, you're particularly high maintenance, and I got to make it, I'm going to charge you 200%. So the trades are made in the New York. Who cares? The execution price is 15 for ABC, 750 for M&O. In order to a violation of the FINRA 5% policy, the member firm. So consider this to be a single transaction. Yeah, that's what a proceeds transaction is. It's, sell A to buy B. So for example, if I charged you $3,000 to sell $100,000 worth of stock A, and you took the 100,000, bought stock B, and I charged you 3, I didn't charge you $6,000 on 200. I charged you 6,000 on 100. That's 6%. Is that a violation? No, because it's a policy. Then I should be able to articulate it. Let's see. B says considers this one single rather than two separate when determining the markup. Well, there's not a markup here because it was a New York Stock Exchange. Markup would be I'm a market maker. The 5% policy applies to this, but there isn't a markup because on the New York, there aren't market makers. So that's why that one's wrong. Considers to be one single transaction rather than two separate. Well, again, there's no markup or markdown because this is not an over-the-counter stock. And let's see, give it advance notice might be slightly higher. Well, disclosure kind of helps, but that's not alone. So A is the best answer. Let's see what Kaplan says about this. Proceeds transaction, I like that. We will buy that. I like that. Agency capacity. So they're testing on two things. You should know that the New York Stock Exchange can best be characterized as an auction order driven market. We're just matching buyers with sellers. As contrasted test question to NASDAQ, which can best be characterized as a negotiated quote driven market.
Mhm.
And that's why this is not correct, because these markups and markdowns, those are associated with over-the-counter transactions. So that was a
Okay.
tough one. That asked you to kind of know
Yeah.
two things to get one answer.
I had B, so they definitely got me on the, I didn't.
Well, now you know, right? Markups are not on the New York, markdowns. On New York, they're matching buyers with sellers. I always think, Cynthia, of like Sotheby's, right? Or
Mhm.
Christie's. Those are auctions. They don't actually have art in inventory. What Sotheby's and Christie's do is just match buyers with sellers, and they take a commission. Now, Cynthia, be careful. There's another way to get art. You could go to an art dealer, right? And if you go to see an art dealer, they have art in inventory. Nothing wrong with that. But now they're trading against you, right? If you're going to buy the art, it's going to be a markup. And if they want you to, if you want them to buy your art from you, it's going to be a markdown, right?
Mhm.
Erica, my God. All right. These are the last three, and then we're calling it a day. Let's see. I got to go back and get the 66 Q back. Oh. By the way, you guys, I don't know if you're just coming up with the QIDs on the fly, but if you're coming in the office hour, you should have your QIDs ready. This is not something that, along the way you find things. Let's see if I'm in the right Q bank. I may not be. Oh, sorry, I'm in the wrong Q bank. 66. Where are you? 66. There it is. Okay, so last three here on 66. Now, Cynthia, Ray, are you guys taking 66 next? Or are you taking 63?
60.
So, this, I guess you could think of this as a preview of coming attractions. That is not
Deep
coming up.
Try 65. I'm in a little group and I think that this came from 65, but it correlates over.
So the office hour isn't for your study group. The office hour is for individuals who've paid for Dean's something from Dean.
I know, but it's for me because it stumped me.
Well, listen, I'm just telling you, I feel no obligation to do that. Okay, let's see. So let's try the 65 back. You should tell them to go buy something from Dean so they can attend the office hour.
It's a buffet.
Let's see. Let's see. So oh, Cynthia, man. All right. Woohoo. Going to be a babysitting sevens is what that's all about. 3382. That's not coming up. Erica, are you sure it's a Kaplan question? Let's try the other one. 126 3815. Nope.
I'm letting you off the hook early tonight.
That's part of it. Some days I get to stay late. Some days I get to go have dinner with mom. Yeah, so just cut and paste those, Erica. If your study group, I don't mind explicating those questions. I don't, it's not part of our office hour, but if you want to cut and paste them and send them to me, I'm more than happy to explicate them that way. Or, if the number comes up, then I'm happy to do it here. All right,
Well-
ladies. So there's a new office hour up already. And so if you want to front run on the next office hour, it's up on the schedule. Anything else?
Dean,
Yeah.
I sent you questions and email to explicate.
Oh, I haven't seen your email. When did you do it?
I've been waiting for a few days, so I think I sent it to you
There's
last.
two on the channel. The email you sent me, there already are video explications of the questions you sent me on the channel.
Okay.
Did you check the videos on the channel? I posted the videos on the questions. If not, send me another email, but the email questions you sent to me, I made video explications. They're on the channel.
Okay. I'll have to take a
Check.
look.
Yeah, check it out, because that was a few days ago, and they're there. I'll try and remember to send you an email, say, hey, they're on the channel. All right. Okay, if you are watching the replay here, feel free to join us. As you know, as I just chastised my friend Erica, the office hours are for people who have paid for something. We don't allow free riders in our paid free study hours. So it's for people who have either bought tutoring or have bought a class, and then that unlocks the free office hours. We also have free for everybody our live stream overtime sessions, and that's free for everybody. And you can find that on the booking page as well. Okay, so remember, inch by inch, your exam is a cinch. Yard by yard, your exam is hard. And we'll see you for the next live stream session or the next office hour, or we'll see you on the channel. You're very welcome, Ray. I appreciate you, Ray, just joining, going along for the ride. And we did have your one question. But remember, if you are participating in the office hours, keep your Dean bucket list there, your Dean to-do list of things you want to do, and have it organized so that when we're doing it, like Cynthia, we can knock it out. Erica showed up, but sometimes it's just Erica, or it could have just been you, Cynthia. And then you end up with a free hour of tutoring, a $225 value for free. All right. Anything else?
Thank you, Dean.
My pleasure, ladies. I don't know what's wrong with the gentlemen. How come we don't get any gentlemen?
Don't poke the bear. We can leave
They're
it
not as cool as us.
Okay, guys.
like this.
Or gals, I should say gals. I'll see you next time.
Yeah.
Bye-bye.
Thanks, Dean.
Thank you, Dean.
You bet.